Hi, everybody. This is Marty Ferpoli with the Insider Exam Prep. Here to talk about Assignment 7 of CPCU 520. This material is about rates and rate making. And unless you are an actuary or somebody who really loves math, you just might find this to be the most difficult assignment in 520. So let's be sure we understand the fundamentals up front, because then the rest of the material really makes sense. Let's begin with the big picture. We're going to be talking about exposures, exposure units, rates, premiums, losses. All through this assignment, we keep coming back to these four concepts with some pretty serious calculations. So if you are grounded in the basic terms, you are then well positioned to master the things you need to know for the exam. So let's dig into exposures, exposure units, rates, premiums, and losses. An exposure is a measure of risk. That is a fundamental building block. In a general sense, exposure refers to the presence of risk. The insured is exposed to risk and then transfers that risk to the insurer. The insurer accepts the risk, and the risk is really the financial consequences of a covered claim. The insurer accepts that risk in exchange for the premium. But how does the insurer know how much to charge for accepting the exposure? The insurer begins by knowing how the exposure is measuring the risk. In workers' comp, for example, the more workers you have, the higher the risk. If you have 100 workers, there's a much greater chance of someone getting injured than if you have 10 workers. And during the course of the year, employees may come and go. An insured may have 100 employees when the policy begins, hire some people, gets up to 105 or 110 employees, but then as the year goes on, lose workers and maybe ends the year with a staff of 90. So it's hard to use headcount as a measure of exposure during the year because it fluctuates. So instead of headcount as a measure of exposure, workers' compensation uses payroll. At the end of the year, the total payroll is a pretty good proxy and a pretty good measure for how many workers were covered. Let's talk about the exposure unit. In insurance terms, exposure unit simply means the way in which exposures are counted. For workers' comp, exposures are counted as per $100 of payroll. So in an example, a store paid its workers $250,000 over a year. That would mean that the number of exposure units are 2,500, which is simply the total payroll of $250,000 divided by the amount of an exposure unit per $100 of payroll. Conversely, if we look at automobile insurance, the exposure unit is expressed as car months or sometimes as car years. So one car insured for a year is one car year or 12 car months, depending on whether you're using a unit of car years or car months. Let's return to workers' compensation. Some jobs are performed at a desk and involve relatively little injury. Those workers are classified broadly as clerical, and the cost to insure them is lower. Other workers have dangerous jobs, working with heavy equipment or working on roofs or with chemicals in high-rise buildings. So many dangerous job classifications. And they all carry different rates. But let's say, for our example, that the rate for a desk worker is $1, and the rate for a high-rise construction worker is $8. And let's say that each of these workers earns $60,000 a year. That $60,000 is going to be 600 exposure units. For the desk worker, 600 exposure units times the $1 rate means that the cost to provide workers' comp for that worker for 1 year is $600. For the construction worker, 600 exposure units times the $8 rate means that the cost to provide workers' comp for that worker for 1 year is $4,800. Boom. Now you have the basics on exposures, exposure units, and rates. How does the insurer establish the rate? The rate is determined by the insurer knowing or predicting what its costs will be. We see here on the screen, insurers need to cover three types of costs: the losses on covered claims, its underwriting expenses, and profit and unexpected expenses. And those unexpected expenses you will see referred to often as contingencies. So within losses include actual claim payments, also money that has been set aside for ongoing claim payments. That's known as loss reserves, also called outstanding losses. It's money the insurer expects to pay on claims. And it also includes the expenses associated with claims handling. And then the profits and the unexpected expenses. Profits pretty much make sense. Insurers want to make a profit, most of them. And unexpected expenses are, for instance, a hurricane or a catastrophic event that is going to have a big jump in claim payments that wasn't built into the insurer's expectations. And so out of those three major components of a rate, the amount needed to cover claims is also known as loss costs. The actuary's job is to look at the insured's historical data on premiums, exposures, and losses, and then project that forward to make rates for future policies. Oddly, the premiums are the least important piece. Premiums are generally backwards looking. We know how much premium we collected, but to determine how much premium we need in the future, we're going to look at our exposures in the future and our losses from the past projected forward commensurate with those exposures. But premiums and exposures typically go together. You have to measure the exposure to know what the premium is going to be. So here's an example. Imagine a car insurer that earned $10 million in premiums over a one-year experience period. During that time, it incurred $7 million in losses and $2 million in expenses. And let's be careful with the term expenses. When you hear the word expenses by itself, it typically means underwriting expenses. And that's just the cost of doing business. But sometimes it refers to loss adjustment expenses. And that is a piece of the total incurred losses. So generally, if it's about the losses, it will be expressed as loss adjustment expenses. If it's about the underwriting expenses, you might see the word expenses alone. Just remember, when you see expenses, make sure you know which one is being referred to, because that's really going to change the calculations you'll be asked to perform. So back to that example, $7 million in losses, $2 million in underwriting expenses. If in the coming period, it will have the same number of insured cars, exposure units, and the same underwriting expenses, then the actuary will project the future cost of claims by beginning with the $7 million of incurred losses in the previous experience period. She may project a higher or a lower number based on all sorts of internal and external conditions like car safety features, inflation, average miles driven, any and all of the things that could affect the cost of claims going forward. She may also know if the insurer's underwriting expenses are expected to change. She needs to project a rate that will cover the claim costs, the underwriting expenses, and has an allowance for profit and contingencies. Seems to me like this is a pretty difficult job. So what do you need to know when you're looking at assignment 7 of CPCU 520? As always, pay attention to the objective in the bold red font at the beginning of the module. At the end of the module is the glossary of key terms. At worst, the very least you should do is memorize them, but much better is to understand them well enough that you can paraphrase them, because then when you see them in a case type exam question, you'll be able to apply it because you actually understand it. So work on paraphrasing those key terms. And of course, the important thing that you have in this product here is all of these rigorous exam quality practice questions. Drill, drill, drill with those questions. This is a very long and complex assignment within 520. The practice questions that follow will give you plenty of opportunity to test your knowledge here. And now that you are grounded in the fundamental concepts of rate making and rates, you're ready for the deeper dive. I'm not going to wish you good luck. Luck is not a factor, only preparation is. Please remember that CPCU students are pledged to ethical behavior. These study materials may be used only by the buyer and may not be shared, transferred, or sold to others. I'm grateful for your cooperation. The Institutes and CPCU are trademarks of the American Institute for Chartered Property Casualty Underwriters, doing business as the Institutes. Longhorn Knowledge Resources, LLC, and the Insider Exam Prep are not affiliated or associated with the Institutes in any way, and the Institutes do not endorse, approve, support, or otherwise recognize Longhorn Knowledge Resources, LLC, or its products or services. CPCU is a registered trademark of the Institutes with all rights reserved.